Hello there learners. Welcome to the last video of Module 5 of the MOOCs entitled Rural Development in India. In this video, we'll discuss NABARD, the recent innovations in rural credit system, and the problems of rural credits in India. Let us first discuss about National Bank for Agriculture and Rural Development, that is NABARD. On the recommendation of the Sivaraman Committee, appointed by the Reserve Bank of India in March 1979 to study the problems related to the agricultural credit, NABARD was established on July 12, 1982. It was established as an apex bank for the agricultural credit. This was expected to play an important role in the agricultural and rural development. This apex development bank was established for the promotion of agriculture, small-scale industries, cottage and village industries, and other allied economic activities in rural areas. NABARD focuses on the following activities. Number one, it plays the role of apex institution in respect of all matters relating to policy and planning and operational aspect relating to promotion of credit for agriculture, small-scale industries, cottage and village industries, handicrafts, and other allied economic activities in the rural area. Number two, it serves as a refinancing institutions for providing long-term and short-term credit for promotion of activities in rural areas. NABARD performs three key functions. They are: number one is credit function, number two is regulatory functions, and number three is development functions. Following are the principal credit functions performed by NABARD. Number one, refinancing facility. NABARDs offer refinance facility by way of short-term credit to cooperative banks, sectoral banks, and other financial institutions. By doing it, NABARD seeks to promote marketing of agricultural product, distribution of agricultural input to the farmers, and producing and marketing activities of cottage and small-scale industries, and production and marketing activities of cottage and small-scale industries. Number two is medium-term credit. NABARD offers medium-term credit for a period ranging between 1.5 years to 7 years to state cooperative banks and regional rural banks. The next is long-term credit. NABARD offers long-period credit for a period not exceeding 25 years to the state cooperative banks, RRBs, land development banks, and also to the commercial banks. The fourth finance function of the NABARD is conversion facilities. NABARD offers conversion facility to state cooperative banks and RRBs for a period not exceeding 7 years under conditions of drought, famine, or other natural calamities. Credit to state governments is the next function. So it provides credit to state governments for period not exceeding 20 years to enable them to subscribe directly or indirectly to the share capital of cooperative credit societies. Share capital is the subscription to the share capital is another financial function performed by NABARD. So NABARD subscribe to the share capital or invest in securities of any institutions concerned with agriculture and rural development. Under regulatory functions, NABARD perform the following activities. Number one, the Banking Regulation Act of 1949 empowers NABARD to undertake the inspection of cooperative societies other than primary cooperative societies and RRBs. Number two, any RRBs or a cooperative society seeking permission to open a branch will have to forward its application to the Reserve Bank of India through NABARD. The RRBs and the cooperative banks submitting their returns to the Reserve Bank are expected to furnish copies of such return to NABARD. Again, the NABARD has been granted powers to call for any information or statement from the cooperative banks and the regional rural banks. So this was all about the regulatory functions. Under development functions, NABARD undertakes the following activities. It formulates credit plan, builds institutions, promotes research and technology, induces innovations in credit delivery mechanism, focuses on skill upgradation of beneficiaries and client banks. NABARD coordinates the operation of rural credit agencies, develop expertise to deal with agricultural and rural problems, assists government, reserve banks, and other institutions in their rural development efforts. Based on its financial, development, and supervisory roles, the National Bank for Agriculture and Rural Development has a wide range of achievements in the rural economy. The institution provides significant refinance support to financial institutions like cooperative and regional rural banks for both short-term loans for crop production and long-term loans for investment in agriculture and allied activities. NABARD has successfully promoted microfinance by linking self-help group with banks, thereby providing formal financial access to millions of rural households, particularly women. It also manages key government funds, including the Rural Infrastructure Development Fund, which finances crucial rural infrastructural projects, and the Kisan Credit Card schemes, which offers farmers timely and hassle-free credit. Additionally, NABARD has initiated promotional and development programs for non-farm sectors, established state-level agricultural development finance corporations, and updated its regulatory framework for cooperative banks to foster a more competitive banking environment. In conclusion, we can say that NABARD plays a pivotal role in ensuring the flow of credit, improving institutional efficiency, and strengthening the overall rural economy. Let us discuss the recent innovations in rural credit in India. In recent years, rural credit in India has undergone a steady transformations, shaped by technological innovations, institutional reforms, and policy interventions. This census aims at making credit more accessible, timely, and efficient, especially for small and marginal farmers, rural artisans, and micro entrepreneurs. Following are some important recent innovation shaping the rural credit. Number one, microcredit by banks. Provisions of microcredit by banks has emerged as an important instrument for alleviating poverty, particularly in rural areas, as this raises the productive capacity of the beneficiaries. Banks were accordingly advised in February 2000 to make microcredit an integral part of their corporate credit plan. Microcredit was added as a part of banks' priority sector lending since February 2000. The next is Payments Bank. So it is a new banking model in India. The establishment of payment banks is a result of recommendations made by Committee on Comprehensive Financial Services for Small Businesses and Low-Income Households, headed by Nachiket Moore and conceptualized by the Reserve Bank of India. According to the operational guidelines for payment banks, these banks can accept a restricted deposit, which is currently limited up to rupees 1 lakhs per customer and may be increased further. The basic objective of payment bank was to increase financial inclusion in the countries, especially in the rural areas, by providing access to small saving accounts and payments, remittance services to the unbanked migrant labor, low-income group families, small businesses, other unorganized sector organizations, and users. Then microfinance is another term for microcredit. Microfinance can be understood as a system of credit or financial services that caters to the need of lower income classes. On a large scale, microfinance is an effort towards a world where low-income groups have access to affordable financial services, which includes saving, credit, insurance, remittances, and payments. We have the homegrown model of microfinance, that is self-help group model. SHGs can be defined as a group of association of poor people who belongs preferably to the same socio-economic background. Self-help and mutual help are some of the way by which these people come together in their difficult times to solve their common problems. NABARD has been one of the pioneers in implementing and conceptualizing the concept of group initiative, and it is also started the self-help group bank linkage program in the year 1992. Then comes the business correspondence model, that is BC model, also known as the third-party agent model of banking. It is one of the several measures being used by the Reserve Bank of India to achieve the larger goal of financial inclusion in India. The model was promoted by Reserve Bank of India in the year 2006, post recommendations of the Khan Committee report. The model permits banks to appoint third-party agents to provide banking and financial services on their behalf, hereby creating opportunities for a wide range of institutions and individuals to work as bank correspondent on behalf of the bank. Business correspondents work on the basis of a commission model. They receive a commission from the bank for the services rendered by them, like each new account opened for customer, money transfer transactions, or new loan disbursed. The business correspondents handled the task of collection and payment of small value deposit and withdrawals, facilitate disbursing of small loans like entrepreneurial loans, agricultural loans, group loans, etc. Collect payments and fees from customers and other functions related disbursement and collection. Then the joint liability group. To support landless farmers, tenant cultivators, and rural artisans, NABARD promotes joint liability group, that is JLG, where a small group of borrowers is jointly responsible for loan repayment. Microfinance institutions, that is MFIs, provide small loans without collateral. This model helps credit excluded group gain financial access. This model helps credit excluded groups gain financial access. Financing of JLG was introduced as a pilot project in 2004. In 2004-05 by NABARD in 8 states with the support of 13 RRBs. The scheme was later mainstreamed for the banking system in the year 2006. These joint liability groups are informal groups of 4 to 10 members who are engaged in similar economic activities and are willing to jointly undertake the liability to repay the loan taken by the group from the banks. Then there is another initiative taken by the NABARD, that is the Rural Infrastructure Development Fund. It is a fund established by the Government of India in the year 1995-96 through the National Bank for Agriculture and Rural Development to support public investment in rural infrastructure. It provides low-cost financial assistance to state governments and other entities for projects such as roads, irrigation, power, and sanitation, aiming to bridge the rural-urban infrastructure gap. The fund was created to address the inadequacy of critical infrastructure that hindered banks from meeting priority sector lending target for rural areas. Another such initiative is the Kisan Credit Card, that is KCC scheme, introduced in the year 1998, provides farmers with timely credit for cultivation and other needs through a single window system. The scheme is aimed at meeting short-term credit requirements of crop cultivation, post-harvest expenses, and product marketing, along with consumption needs and working capital for allied activities. Benefits include a competitive interest rate due to government subsidies, collateral-free loan up to Rs 1 lakh, and a flexible limit for the marginal farmers. Then the Financial Literacy and Inclusion Campaign. The government and the RBI conduct rural financial literacy drives to spread awareness on safe borrowing, digital payment, and savings, reduce financial exclusions in remote areas, promote responsible credit utilization among the rural people. Then, digitization of agricultural lending, the NABARD and eKCC portal. One of the most significant step forward has been the digitization of loan origination and processing for agricultural credit. This portal enables fully digital, paperless processing of credit applications, particularly for customers of cooperative banks and regional rural banks. Through eKCC, farmers no longer need to make multiple visits to bank branches or stand in long queues. The loan application, verification, and disbursal are streamlined. Then, expansion of digital infrastructure, financial inclusion, and bank connectivity. Beyond loan-specific portal, NABARD has promoted broader digital infrastructure across rural banking institutions. Under its initiative, a large number of cooperative societies, that is PACS, have been computerized with cloud-based common software and integration with core banking system of district and state cooperative banks. The recent innovations in rural credit, especially digital loans origination, expansion of banking infrastructure, structured credit schemes, and fintech-backed alternative lending are reshaping rural finance in India. They are helping to increase access to formal credit, reduce the time, cost, and paperwork, enhance financial inclusion and saving mobilization, promote transparency, accountability, and efficiency in rural banking and credit delivery, support rural livelihoods and economic resilience for small and marginal farmers and rural micro entrepreneurs, reducing dependence on informal moneylenders. So, this was all about the innovations that are taking place in the area of rural credit or rural finance. Let us discuss the problem of rural credit in India. India's rural credit system, while expanded through government initiatives and financial institutions, face systematic issues that leaves many farmers, especially the most vulnerable, reliant on high-cost informal lenders. Following are some key challenges of rural credit in India. Number one, insufficiency. In spite of expansion of rural credit structure, the volume of rural credit in the country is still insufficient as compared to its growing requirement, arising out of increase in prices of agricultural inputs and other raw materials. The next is inadequate amount of sanction. The amount of loan sanctioned to the farmers by agencies is also very small, which is inadequate for meeting their different aspects of operations. Considering the amount of loan sanctioned as inadequate and insignificant, the rural citizens often divert such loan for unproductive purposes and thereby dilute the very purpose of such loan. The next is lesser attention of poor farmers. Rural credit agencies and its schemes have failed to meet the needs of the small and marginal farmers. Thus, lesser attention has been given on the credit needs of the needy farmers, whereas the comparatively well-to-do farmers are getting more attentions from the credit agencies for their better credit worthiness. The problem of overdues in rural credit continues to be an area of concern. The recovery of advances to various institutions is also not at all satisfactory. As a result of that, the credit agencies are becoming wary of granting loan to the farmers and other rural areas. Next is the inadequate institutional coverage. In India, the institutional credit arrangement continues to be inadequate as compared to its growing needs. The development of cooperative credit institutions like primary agricultural credit societies, land development banks, commercial banks, and regional rural banks have failed to cover the entire rural farmers of the country. Consequently, informal moneylenders and other non-institutional sources continue to play a major role in providing credit to rural households. The next problem associated with rural credit is red tapeism. Institutional agricultural credit is subject to red tapeism. Credit institutions are still adopting cumbersome rules and formalities for advancing loans to farmers and rural artisans, which ultimately force them to depend more on costly non-institutional sources of credit. The next problem is high transaction costs. Reaching the rural population and supervising rural bank branches can be expensive for financial institutions. For borrowers, costs include travel expenses, loss of working time, and other expenditures. The next is climate risks and low productivity. The high risk nature of agriculture, driven by weather-related factors, and low productivity due to outdated farming techniques, make it difficult for farmers to earn enough money to repay their debts. Then the next problem is regional disparities. Agricultural credit disbursement is unevenly distributed across the different regions of the country. Some areas, like southern region, receive a disproportionately higher share of credit compared to central and eastern state, which leads to increase in the inequalities among the regions. Then the negative impact on credit culture. Some loan waiver schemes of the government have sometimes discouraged prompt loan repayment and created expectation of future waivers, undermining the credit disciplines needed for a healthy rural banking system. So this was all about the problems of rural credit or rural finance. So with this, we will conclude this module entitled Rural Development in India. Thank you for watching.